Welcome. This is Steve Brennan with Select Financial Capital. Today I'm joined by Zach Preminger and Jeff Chandler, also of Select Financial Capital. And we're going to be talking a little bit about what really matters when it comes to investing in commercial real estate. And it's not the headlines, it's really the investing basics. And for that, we're going to be talking about a recent property deal we did involving Washington Square, which was a value add office property we purchased right before COVID. And I think we'd all agree that we had some unexpected challenges there, but we actually did very well for investors. And despite what you might think with the headlines suggesting that COVID with the lockdowns and remote work really kind of torpedoed all office properties, that wasn't the case. And, they were talking about what really did matter and a little bit about that adventure of doing a value add office property during COVID. So right off the basis, let's start with financial modeling, because when we first looked at this, one of the things we did was stress testing. And we really kind of looked at what we were paying for it and what a recession condition could be like and how could we proof it against that. Jeff and Zach, you guys kind of care to share a little bit of what goes into stress testing a financial model? So you're not investing based on a best case scenario, but you're preparing for some negative outcomes also.
Sure. So when we're looking at the modeling of a property, while how much you earn is important, it's not as much important as how much you could lose and how you protect yourself from that. So when we stress test a model, we'll play with vacancies. We can start at 100% occupancy and we can drop it all the way down to 40 or 50% occupancy, which would be, a 60% vacancy, which is incredibly extreme. I don't know that we've ever come across that, but we like to see what happens in a kind of catastrophic situation. We'll also look at rents much higher and much lower than what the market rents are and what the building rents are. So, you have two different scenarios there. You can also combine scenarios where you have a vacancy issue and you have a rent issue, and you can see how things can compound in situations like that. We also look at situations where expenses could go haywire. And there are also situations where you have unexpected events where people will just up and quit, and how that would affect your OPEX and your building standards, which then could also further compound negative situations of the property. These are just some of the things that we look at, but it all goes into a formula of how we look at real estate to see what a property could be able to withstand and in what circumstances. And those stress tests push basically, a predicted recession, even if there isn't one. So when something like COVID hits, we were already a little bit ahead of the curve. We had already seen what could happen, and we were better equipped to ride through that pandemic.
Yeah, so I think, none of us saw a global pandemic that was going to cause shutdowns around the country, and all of a sudden, see people, anybody who could would be working from home. None of us saw that. But I remember when we were modeling this property, we were talking about there hasn't been a recession in a while. We've got to be concerned there might be a downturn. And I think that's just part of the basics if you're doing this job right, that you start looking at some numbers and you say, okay, what happens if we do hit a rough patch here? So you're not totally scrambling and you don't know how you're going to make your numbers if you do hit a rough patch.
Right.
The other thing I want to kind of bring up is there's that old joke in real estate that the three most important things are location, location, and location, right? That there's some truth to that. And where we bought was, Miami. And, we didn't know just how well Miami was going to do during COVID because, we bought right before the outbreak. Nobody was talking about it. But maybe, it wasn't a pure accident that we were in Miami and we did as well as we could. So, Jeff, maybe you could talk to a little bit about why Miami? Why did we go into one of the markets that did so much better than other markets pre-COVID?
I think that's an interesting statement, I guess is a better way to put it. Miami, primarily because there was, there's a lot going on. You've got the ports, you've got, which house not just cargo, but cruise ships. So, it's a destination. It's become a destination for big business to not just come and vacation, but to move from New York City, from California, from, flyover states, et cetera. And then add to it, I think, with the building location that we were speaking of, within an hour, you're within reach of 75% of the total South Florida population, which is enormous. So, you add to not just the demographics, the numbers seem to make sense. With a lot of people coming in, the lack of office space that's around, it seems to make sense. But you also made a comment about, what made us think of it. I think in a lot of ways, something that Zach said too is what we're looking at from every theoretical direction we can, or perspective we can. To actually go and invest in the project the way we do, you've got to question whether or not you're doing the analysis correct. And that's the reason why we stress it. We stress the demographics, we stress the modeling to make sure that it's a viable investment.
Yeah, I would also add in there, and Zach, I think you agree with me. A business-friendly climate was something we liked about Miami, not just the demographics, but that we felt we were investing in an area where we weren't going to be fighting against a regulatory environment that made doing business for us more difficult. That we certainly could have looked at places like Chicago or San Francisco or New York, but one of the reasons we picked one of the places that had ended up having a very business-friendly policy during COVID was it had a very business-friendly policy pre-COVID.
Yeah, that's right. And, it does make a project go a lot easier when you're being supported by the municipality instead of fighting them. That is absolutely true. So we always try to find investments in that kind of a scenario or situation, because you'll find more value in the businesses and more value in the real estate when you're being supported, for sure. And Miami has a great business climate, and we knew that. And that's another reason that it was an area that we've been targeting and working in for a long time.
And
something I would add is,
you could also add to it, when you've got you said location. It's not always, it is location, but in a lot of ways it's where the traffic's moving or where it's going. So you can find good opportunities along major pathways where there's a lot of population moving to and from. You can take something and make it better just by sheer population going by and putting a value add project together.
Yeah, and certainly, you had with COVID a lot of people moving into Florida because of some of those more business-friendly policies or whatnot. But that merely accelerated a trend we'd already identified. Florida was already demographically positive. Those trends were already there. COVID just kind of supercharged a move out of or less interest in some regions and more interest in a move more into other regions. And Florida was a beneficiary of kind of that supercharging of all of a sudden having even more people coming in than I think we even anticipated. But we did anticipate the trend.
Yeah.
So another thing I want to point out is the financial modeling obviously is important. The getting the location obviously is pretty important. But there's an element here of just a lot of freaking hard work and the leasing and the property management. So I do think that, especially Jeff, with you sitting there in Florida and having been on site a lot, there actually turned out to be more hard work than we anticipated due to COVID. There was extra work we just had to put in to make this work on the leasing and the property management front, and old-fashioned hard work played into this.
Yeah, look, the truth of it is, Zach and I both put in a lot of hard work. He may have been remote, but I think what really comes in a project like this is you're right, it's tedious, time consuming. But what we are ultimately trying to do on any given property, tenant, unit, whatever we're trying to do, the staff that's on site, et cetera, is retrain them to think, of what we're trying to do, what we're trying to attain, and retrain our tenants to understand that this is, this is a business, this is a property, this is where they're coming to, enact their business, and it needs to be treated that way. And, and it helps when you can do that, but it does take time. And, COVID added I think just a layer that we weren't, that nobody was really prepared for to a large degree, but it also allowed us to, I don't want to say recreate the wheel, but allowed us to redesign and replan how we were going to do it. Instead of initiating policy changes right out the gate, it allowed us to look at them, think about them, and modify how we wanted things to occur and how we wanted people to transition in and out of the property. So yeah, it was definitely interesting. It was definitely interesting. It was time consuming and tedious. I don't know that I'd say it's more work than I thought it was, but it was a lot. That is for sure.
Yeah, and I think it would be great if there was some crystal ball out there that we could peer into and be like, hey, there's a global pandemic ahead. It's going to really make things difficult for certain segments and certain markets. Nobody has that. So I think it kind of comes back to the keys of success being the basics. Do good financial modeling, make a robust model, anticipate some downside. Pay attention to demographics, supply, demand. Try to get the right location, get a place where the trends seem to be in your favor, and then hopefully you can ride them out, or maybe even something comes along that accelerates trends in your favor.
Yeah.
And then just the basics of it, you still got to get in and manage the place and lease it up. And I think that's when actually, in this case, one of the big value adds we saw is prior teams, we saw just hadn't done a very good job of that. And we really thought if we stepped in and worked really hard, we could outperform them. And I think that thesis bore out because especially, with you two guys spending so much time on that, I think you really actually managed to outperform that prior team during a global pandemic versus what they'd done under much more benign conditions, by simply knowing what you were doing and doing the hard work.
Yeah, look, and you never want to you never want to create any problems for prior owners, but to a large degree, when you're talking about normal property managers, sometimes it's not their property. They don't they don't treat it as such. And we take a different approach to it from the property management side, where if it's ours or not ours, we're going to approach it as if it's ours and make sure that we're saving every dollar we can. We're going to approach it as and from the direction that we want to not just save dollars, but take care of tenants. Get the property optimized so that we can make it a good investment.
Okay.
Sorry, Zach, I didn't mean to cut you off. So.
No, I mean, you said it. I was going to say streamline, and that's what we do. We try to create efficiency and put it through our process, and by doing so, we hope to create value. So I think you nailed it.
And I do think one other thing worth mentioning here that we were talking just a few minutes ago offline about is diversification. That even if you get all of the basics right, you can still get black swan events. You can still get problems with individual properties, and it is important to not just put all your eggs in one basket. If you can run a portfolio, get exposure to some different properties, and then try to go about get the right location, pay attention to basics, do the right management, do all that, and then try to kind of spread your risk out a bit. Yeah. Because the fact is this isn't a magical formula for always making money. So outliers can still happen. What I think this
Absolutely.
is more important for is if you have a portfolio of properties and you follow these steps, you should do pretty well.
Yeah, I mean, look, the truth is you're right. You don't have a crystal ball. You can't really tell when things are going to happen that are outside your control. And to your point, you can diversify not just in other assets, but in additional tenancy, reducing tenant size. There's a number of things that you can do to reduce risk. And along the way, you do learn these, and you learn which ones could be potentially your problems, and you mitigate that.
Sure. So I don't think we're relaying anything that's really groundbreaking here. This is pretty basic stuff. Do your modeling, don't expect, sunshines and rainbows always. Plan for some downside. Make sure you have some room in there with your numbers and with your financing. Spread your risk around. Have exposure to multiple properties. Spend your time running the place. Put the effort into managing the property, into leasing it up. Get on the ground if you need to. Make sure you have the right people there. But I think it just kind of comes down to, as exciting as the headlines can be, it's really kind of that day-to-day basics stuff from the spreadsheet to the leasing that really is what's going to matter.